Let's face it, crypto can be a roller coaster. You've probably heard stories of massive gains, but behind the scenes, countless investors are quietly losing money by making avoidable mistakes. The truth? Most losses don't come from the market itself, but from poor decisions and a lack of preparation. And if you're not careful, these pitfalls could wipe out your portfolio faster than you think. From ignoring taxes to trusting the wrong exchanges or chasing unrealistic returns, the crypto market is full of traps waiting for the unprepared. But here's the good news, you don't have to learn the hard way. By understanding the 15 most common mistakes and how to avoid them, you can protect your investments and make smarter, more profitable moves. Welcome to the Chainpoint channel. In this video, we'll break down these mistakes one by one, giving you practical advice to stay ahead of the game. Whether you're a seasoned investor or just getting started, this is the guide you need to stop losing money and start making better decisions in crypto. Ready to level up your investment strategy? Let's dive in. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. The first mistake we will cover is ignoring tax implications. One of the most overlooked aspects of crypto investing is taxes. Many investors don't realize that every trade, sale, or even a swap between cryptocurrencies is considered a taxable event in most countries. Capital gains taxes, whether short-term or long-term, can add up quickly if not properly tracked. For example, someone trading Bitcoin for altcoins during a bull market might face significant tax liabilities by the end of the year, especially if gains aren't reinvested strategically. The consequences of ignoring taxes can be severe. Governments worldwide are cracking down on crypto tax evasion, leveraging blockchain analytics tools to identify unreported transactions. Imagine waking up to a hefty fine or legal notice simply because you weren't prepared. Using crypto tax software like Coinly or CoinTracker can simplify the process by automatically calculating your gains and losses. Staying compliant not only keeps you out of trouble, but also allows you to sleep better at night. Taxes aren't just about penalties, they're also an opportunity. Proper tax planning can save you money. For instance, tax loss harvesting allows you to offset gains with losses by strategically selling underperforming assets. Understanding these strategies can make a significant difference in your net returns. As we move into the next topic, let's talk about another common mistake, choosing the wrong crypto exchange and its hidden costs. Choosing the wrong crypto exchange can turn your investment journey into a costly and frustrating experience. With over 200 exchanges available globally, finding the right one requires more than a quick Google search. Some exchanges charge exorbitant fees for trades, deposits, and withdrawals, while others lack support for specific cryptocurrencies you may want to invest in. For instance, using a high-fee platform for frequent trading could drain hundreds of dollars from your portfolio annually. Money better spent on actual investments. Beyond fees, security is another critical factor. Not all exchanges are created equal, and some have a history of hacks or operational failures. Remember Mt. Gox? It handled 70% of global Bitcoin trading before collapsing and losing millions in user funds. To avoid such pitfalls, research platforms with strong security measures like Binance, Coinbase, or Bybit, which offer features like insurance funds and two-factor authentication. Reading reviews and checking exchange histories can save you from potential disasters. Functionality and customer support are often overlooked but vital. Imagine needing help during a market crash only to find your exchange's support team unreachable. A reliable platform should provide easy access to funds, seamless transactions, and responsive customer service. By spending time up front to evaluate these factors, you set yourself up for smoother trading experiences. Next, we'll dive into another costly mistake, chasing unrealistic returns and falling for scams. The promise of guaranteed high returns is a trap that continues to lure crypto investors into scams and Ponzi schemes. It's easy to get swept up by headlines boasting of 1,000% gains overnight, but the reality is far more complex. Projects that promise too much with little transparency often collapse, leaving investors with empty wallets. Remember BitConnect? It drew in thousands with its unsustainable returns, only to implode and leave its victims with billions in losses. The key to avoiding this mistake is due diligence. Before investing in any project, ask critical questions. What problem is it solving? Who are the founders? Does it have a working product or real-world utility? Platforms like CoinMarketCap or DeFi Llama can help you analyze token metrics and on-chain activity. Also, be wary of projects with aggressive marketing but no concrete development. It's a classic red flag. Greed can be a powerful motivator, but it shouldn't cloud your judgment. Focus on projects with realistic growth potential and proven use cases. Aiming for steady, sustainable gains is often more rewarding than chasing the next big thing. In the next section, we'll discuss another pitfall that can erode profits: failing to take profits when the market is in your favor. One of the most common mistakes in crypto investing is holding onto assets for too long, hoping for even bigger gains. While it's tempting to let profits ride during a bull run, the reality is that markets are highly volatile. A 100% gain today could turn into a 50% loss tomorrow. Failing to lock in profits at strategic moments often leaves investors empty-handed when the inevitable market correction arrives. The solution? Develop a profit-taking strategy. For instance, you could sell a portion of your holdings once your asset doubles in value, ensuring you recover your initial investment while still maintaining exposure to potential upside. It's not about selling everything, it's about securing what you've earned. Profit-taking is not a sign of weakness, it's a sign of discipline. Legendary investors like Warren Buffett emphasize the importance of realizing gains when the opportunity arises. By planning your exits ahead of time, you avoid being swayed by market hype or FOMO. Up next, we'll explore another behavior that can lead to losses: trading impulsively based on trends and social media hype. Fear of missing out, FOMO, can be one of the most damaging mindsets in crypto trading. It's that nagging feeling that you're missing the next big opportunity, prompting you to jump into a trade without proper research. Whether it's a trending token or a hyped-up project, acting on FOMO often leads to poor decisions. The problem? Most of these hot picks peak before the average investor even gets involved, leaving latecomers to bear the losses. To avoid FOMO trading, focus on undervalued assets with strong fundamentals instead of chasing trends. For example, rather than aping into a meme coin trending on Twitter, consider researching projects with long-term potential, like those in decentralized finance or gaming. Tools like Messari and CoinGecko provide valuable insights into market performance and token utility, helping you make informed decisions. Remember, investing is about strategy, not speed. Patience is your greatest ally in the crypto market. Avoid being swayed by influencers or social media chatter and stick to your research and plan. While it's natural to feel like you're missing out during a bull run, staying disciplined will often yield better results in the long term. Next, we'll dive into a critical yet overlooked aspect of crypto investing: maintaining strong security practices. When it comes to cryptocurrency, security isn't optional, it's essential. Yet many investors neglect basic security measures, leaving themselves vulnerable to hacks, phishing scams, and data breaches. Weak passwords, reused login credentials, and the lack of two-factor authentication, 2FA, are common mistakes that can lead to devastating losses. Think of your crypto assets as a vault of gold. You wouldn't leave it unlocked, would you? The first step to securing your investments is using a hardware wallet. Devices like Ledger or Trezor store your private keys offline, making them virtually immune to online attacks. Additionally, enabling 2FA on your exchange accounts adds an extra layer of protection. Avoid accessing wallets on unsecured networks like public Wi-Fi, as these are prime hunting grounds for hackers. Treat your crypto assets with the same caution you would a bank account or physical cash. Security doesn't stop there. Regularly update your software, use reputable antivirus programs, and stay alert to phishing attempts. For instance, always double-check URLs when accessing exchanges or wallets. Fake websites designed to steal login details are surprisingly common. By prioritizing security, you're not just protecting your assets, you're protecting your future. In the next section, we'll tackle another costly mistake: overtrading and its emotional and financial toll. Overtrading is a silent portfolio killer, often driven by the illusion that more trades equal more profits. The reality? Frequent trading not only racks up fees, but also leads to emotional decision-making that can erode gains. Even the best traders admit to win rates of just 50–60%, highlighting that losses are a natural part of the process. For most investors, adopting a strategic, less is more approach often yields better results. The emotional toll of overtrading can't be overstated. Watching the market constantly, reacting to every price swing, and chasing quick gains can lead to stress and burnout. Instead, consider a buy and hold strategy for high conviction assets like Bitcoin or Ethereum. Historical data shows that holding through market cycles often outperforms active trading over the long term. A calm, calculated approach keeps you in control rather than at the mercy of the market. To curb overtrading, set clear entry and exit points for your investments and stick to them. Allocate time for market research rather than reacting impulsively to daily price movements. In the next section, we'll discuss why entering the market without a clear plan can lead to impulsive and costly mistakes. Entering the crypto market without a plan is like setting sail without a map. You're bound to drift off course. Many investors dive into the market chasing quick profits, only to realize they've made impulsive decisions without clear goals or strategies. A lack of planning often leads to emotional trading, FOMO, and overexposure to risky assets. To succeed in crypto, you need a blueprint for your investments. Start by defining your financial goals. Are you looking for short-term gains, long-term growth, or diversification? Each goal requires a different strategy. For instance, if you're aiming for steady growth, you might allocate more to Bitcoin and Ethereum, which have proven resilience over time. On the other hand, if you're willing to take on higher risk, a portion of your portfolio can focus on emerging altcoins. The key is balancing ambition with pragmatism. An exit strategy is just as important as an entry plan. Knowing when to take profits or cut losses can save you from holding assets through prolonged downturns. Tools like portfolio trackers and spreadsheets can help you monitor progress and adjust your strategy as needed. Investing without a plan may seem easier, but it often leads to regret. In the next section, we'll explore how using high leverage without proper risk management can magnify losses. Leverage is often marketed as the ultimate tool to amplify gains, but for many investors, it becomes a double-edged sword. While using leverage can magnify profits, it also increases the risk of catastrophic losses. A 10% price drop in a leveraged position can trigger a margin call or even liquidate your entire investment. For beginners and even seasoned traders, this can turn a promising opportunity into a financial disaster. Proper risk management is essential when using leverage. Start by understanding your own risk tolerance and never invest more than you can afford to lose. Use tools like stop-loss orders to minimize potential losses and avoid over-leveraging positions. For example, if you're tempted to use 10x leverage, consider scaling back to 2x or 3x. Smaller leverage still offers amplified returns, but with significantly less risk. Education is your best defense against the pitfalls of high leverage. Study market trends, understand the assets you're trading, and avoid jumping into leverage trades based on gut feelings or hype. Platforms like Binance or Bybit offer demo accounts where you can practice trading with leverage without risking real money. In the next section, we'll discuss another critical mistake: keeping assets solely on exchanges instead of prioritizing self-custody. Keeping all your crypto assets on exchanges is one of the riskiest mistakes an investor can make. While exchanges offer convenience, they also present significant vulnerabilities. Hacks, technical failures, or even regulatory crackdowns can lock you out of your funds overnight. Remember the Mt. Gox disaster or the more recent FTX collapse? These events wiped out billions in user funds, emphasizing the importance of self-custody. A hardware wallet is the gold standard for securing your crypto. Devices like Ledger or Trezor store your private keys offline, making them nearly immune to hacks. By transferring your assets to a hardware wallet, you gain full control over your holdings. No third-party risks involved. Think of it as owning a safe for your digital wealth, ensuring that no one but you has access. If you're unsure where to start, check out our video, Beginner's Guide to Crypto Wallets: What You Must Know, for a complete walkthrough on choosing and setting up the right wallet for your needs. Self-custody doesn't have to be complicated. With a bit of practice, managing your wallet becomes second nature. Platforms like MetaMask or Trust Wallet are great starting points for those new to crypto storage, but hardware wallets remain the safest option for significant holdings. As we move forward, let's examine how blind trust in influencers can misguide even the most cautious investors. Relying solely on influencers for crypto advice is a dangerous game. While many influencers provide valuable insights, others prioritize clicks, views, or paid promotions over genuine expertise. Projects heavily endorsed by influencers often lack transparency or utility, luring unsuspecting investors into risky or outright fraudulent schemes. Remember, not everything hyped on social media is gold. The key to avoiding this mistake is doing your own research. When an influencer promotes a project, dig deeper. Look into its white paper, team background, and real-world use cases. For example, a token endorsed as the next Bitcoin might lack development or adoption. Tools like CoinGecko or Etherscan can help verify token activity and legitimacy. By validating information, you gain confidence in your decisions rather than relying on someone else's opinions. It's also important to diversify your sources of information. Follow reputable analysts, read independent reports, and stay updated on market trends. Blind trust in a single voice can lead to biased decisions, but an informed approach ensures a balanced perspective. The next mistake we'll discuss is the risks of over-relying on speculative altcoins, and how diversification can be your safety net in the volatile crypto market. Altcoins often promise astronomical returns, but putting too much of your portfolio into speculative projects is a recipe for disaster. While altcoins can outperform Bitcoin during specific market cycles, they also carry higher risks, especially during bear markets. A portfolio overly reliant on altcoins can experience extreme volatility, with some assets losing 90% or more of their value. However, diversification across more stable assets can mitigate these risks. Remember, what I will say now is not investment advice, only an example of what you can do to achieve a good balanced portfolio. To strike a balance, allocate a portion of your portfolio to proven assets like Bitcoin and Ethereum while keeping some room for high potential altcoins. For instance, you might dedicate 50% to Bitcoin and Ethereum for stability, 30% to mid-cap altcoins with utility, and 20% to speculative small-cap projects. This approach allows you to capitalize on the upside of altcoins without overexposing yourself to their inherent risks. Remember, not all altcoins are created equal. Focus on projects with strong fundamentals, real-world utility, and active development teams. Tokens in sectors like decentralized finance or gaming often show resilience and growth potential. By diversifying wisely, you reduce the chances of your portfolio being wiped out during market downturns. Next, let's talk about another common trap: getting emotionally attached to specific cryptocurrencies and refusing to adapt to market shifts. Diversification is often hailed as the golden rule of investing, but there's a fine line between being well-diversified and spreading yourself too thin. Over-diversification can lead to owning so many assets that it's impossible to track their performance or understand their fundamentals. On the other hand, under-diversification exposes you to excessive risk, as a single poorly performing asset can tank your entire portfolio. Striking the right balance is key. Think of your portfolio as a puzzle. Each piece, Bitcoin, Ethereum, altcoins, and stablecoins, should fit together to create a balanced picture. For instance, allocating 50% to Bitcoin and Ethereum provides a stable foundation, while 30% in altcoins taps into growth opportunities. The remaining 20% could go into stablecoins for liquidity or emerging sectors like AI or gaming cryptos. One thing to note here is this is not investment advice, but merely an example of how allocation can be structured for balance. Always tailor your strategy to your goals and risk tolerance. Rebalancing is equally important. Market dynamics shift, and your portfolio should adapt accordingly. If one asset surges in value, it might dominate your allocation, increasing risk. Periodically, revisiting your portfolio and adjusting allocations ensures you stay aligned with your goals. Next, we'll explore a mistake rooted in emotions, becoming too attached to specific assets and failing to adapt to changing market conditions. Emotional attachment to specific cryptocurrencies, commonly referred to as marrying bags, can be a costly mistake. It's easy to fall in love with a token you believe in, especially if you've seen it skyrocket in value or resonate with its vision. However, the market doesn't operate on emotions. Clinging to an underperforming asset while ignoring red flags or better opportunities can erode your portfolio over time. Adapting to market conditions is essential. For instance, a project you believed in during a bull market might lose traction in a bear market due to poor fundamentals or weak adoption. Letting go of such assets doesn't mean you're disloyal, it means you're pragmatic. Tools like portfolio trackers can help you assess underperforming assets and decide when to cut losses or reallocate funds to stronger opportunities. Stay objective and grounded in data. Regularly reviewing your investments and comparing their performance to others in the market will help you avoid emotional bias. Remember, successful investors prioritize results over sentiment. In the next section, we'll shift focus to a critical but often ignored topic: how neglecting your mental and physical health can impact your success as a crypto investor. Crypto markets never sleep, and the constant buzz can take a toll on your mental and physical health if you're not careful. Staying glued to charts, obsessing over price movements, or losing sleep during market volatility can lead to burnout, anxiety, and poor decision-making. Remember, even the best strategies fall apart if the person executing them isn't in the right headspace. To maintain balance, set clear boundaries for your trading and investing activities. Dedicate specific times to check the market instead of letting it dominate your entire day. Incorporate practices like exercise, meditation, or hobbies to disconnect and recharge. A walk in nature or a gym session can do wonders for clearing your mind and helping you make more rational decisions when you return to the screen. Spend time with your family or loved ones. These moments of connection can ground you and remind you of what truly matters. A dinner with your family or simply playing with your kids can help you step back, recharge, and make clearer decisions when you return to the market. And also a connection with God to take care of your spiritual side. And lastly, build a support system. Engaging with like-minded individuals through communities or forums can provide encouragement and perspective during tough market periods. And don't underestimate the power of taking breaks. Crypto opportunities will always be there, but your health and relationships should come first. And now that you know the 15 most common crypto mistakes and how to avoid them, the question is, what will you do differently? Will you let these insights guide your next moves, or will you keep repeating the same costly errors? The choice is yours, but one thing's certain: awareness is your first step toward mastering the crypto market. Take a moment to reflect. Are you prioritizing security? Do you have a clear plan? And are you avoiding the emotional traps of FOMO and overtrading? Success in crypto isn't about chasing hype, it's about making informed, disciplined decisions. So, what's your next move? Share your thoughts in the comments. I'd love to hear how you're implementing these strategies. And don't stop here. The crypto market is evolving every day, and staying informed is the key to staying ahead. Hit that subscribe button and turn on notifications so you never miss a critical update. Together, we'll navigate the ups and downs of this exciting market. I will see you in the next video.